Good evening, students. Hope you are able to hear me and see me. Hope the audio and video quality is good. Welcome to Ekcel Academy's live session. Just a second, let me adjust the mic. Yeah. So today we'll be discussing the FM question paper of June 2019. Wherever we had stopped in the previous class, we will continue from there. So I will be monitoring the chat. If at all you have any doubts, please do ask. If you are following the live video, if not, you can always leave a comment below. We'll try to get back to you. So today will be the last live session of question paper solving. We already completed one question paper with respect to CMA paper, and this is the FM paper. So you know that FM is for 60 marks, the remaining 40 is for strategic management, which is not there in the new syllabus, thankfully. Moving on, we had stopped after question number 43. We'll look into question number 44, a theoretical question. Okay, let's see what do we have in store. Debtors turnover ratio reflects what? So this is a very easy question. Debtors turnover ratio is a financial metric, obviously, that I'm sure you know. What does it do? It measures the efficiency of any company's credit sales collection process. So it basically provides insights into how quickly a company is able to collect the payments from its customers who have purchased goods on credit basis, or even services for that matter. To calculate this debtors turnover ratio, we need two key figures: the average accounts receivable and the net credit sales. So the average account receivable is nothing but the money owed, average amount of money owed by the customers for a specific period, whereas specific period usually 1 year. The net credit sales are the total sales made on credit basis. Okay, so formula is very simple. Net credit sales divided by average accounts receivable. So what else? So option, it's easy to select. Option B is in fact the right answer. There is nothing much to do here. A theory question, that too a very easy question. So let's move on to the next one. Okay, question number 45. Consider the following data and compute the total sales amount. Okay, this is again based on ratios. Closing balance of receivables is given. Opening balance of receivable is also given. Fine. Then what else? What else? Average collection period is given. Okay. Credit sales are 73% of year. Assume 365 days in a year. Okay. All the relevant information is given. Now all that we need to do is just identify what exactly total sales amount. Easy actually. Let's try to do this quickly. Let me bring up my working note. So now the question is on the left hand side, of course. So what do we need here? Average receivables. So average receivables would be nothing but the average amount of debtors, average debtors divided by credit sales into usually number of months, or if the days is given, number of days. In this case the number of days is 365. They have mentioned specifically, so they will consider 365. If nothing has been mentioned in the question, rare, but still if at all they do not mention anything, we generally consider 360 days, but in this case they have specifically mentioned how many days, so therefore we are considering 365 days. I hope it makes sense. So now average debtors is easy to identify. We have to just look at the closing balance and opening balance and find out the average. The opening balance was 20, closing balance was 30, so therefore the average would be 25 lakhs divided by credit sales, which we do not know in this case. That is what we are trying to identify, so that will be X. Then we do not know the credit sales, but they have asked total sales. That is still easy to find out. Okay, we'll do that. Now average collection period. So average receivables period, this is average receivables collection period. No, so now that is how much? 25 days. So now with this we can easily identify this will be multiplied by 365. So when you do the math, let's do one thing. 25x equals 25 lakhs into 365. This and this will get cancelled. X will be 365. So now what is X? X is nothing but credit sales. if credit sales is 365, what is the data given in the question now? So in the question they say credit sales are 73% of the sales. Okay. If 73% of total sales is 365, how much would be 100%? So 365 into 100 by 73 will give you the actual data. So that would be 365 divided by 73, which is nothing but 500 lakhs. So that is what is asked, no? Total sales. Yeah. So option B is in fact the right answer. I hope it makes sense. If you have any doubts, please do ask. Next. Fine. Let's move on to the next one. Let me read the question first. If the expected dividend is less than the actual dividend paid, okay, we expected the company to pay, let's say 10 rupees. The company in fact paid 15 rupees. Okay. The rational expectation approach suggests that share price will increase, share prices will go down, value of the firm will go up. Okay. See now, we thought the company would be able to pay only 10 rupees, but the company in fact paid 15 rupees, 5 rupees extra. So in this case, the company exceeded expectations. The company's performance was way beyond what we expected. Maybe the value of the company is, or the share price of the company is undervalued. So therefore, in such a circumstance, the share price will actually increase. So that is what the rational expectation would be. Because higher dividend payment only means what? That the firm is doing well and it's able to generate more and more cash flow than what we expected it to. So this will make the firm more valuable, and investors will be willing to pay more for the shares of the company. So therefore, correct answer in this case would be option A, which was the value of the share price, share value will increase. Next, question number 47 based on EOQ. Okay, let's see. The EOQ for a firm is 7,200. I think we solved one or two problems based on EOQ in the previous session, but let's continue for the 2AB by C, that is known, square root of that. Economic order quantity, of course. For a firm is 7,200 units. The minimum order size stipulated by the supplier is 9,000 units for utilizing a cash discount on the purchase price. Okay. The annual usage of the material in units is 80,000 and the cost per order is 100. So if the company decides to utilize cash discount, savings in the total ordering cost will be how much? Okay, there are two situations here. Based on that, we'll have to identify what would be the potential saving. See, the total number of orders that would be placed if the company does not utilize the cash discount. Okay. So in that case is 7,200. Okay. So the annual usage of the material in units is 80,000 and the cost per order is 100. The minimum order size stipulated by the supplier is 9,000 units for utilizing the cash discount. Now let us look at the situation where cash discount is not utilized. If it is not utilized, then it will be 7,200 units only. And what is the annual usage here? 80,000. Okay, so then we'll have to find out how many orders we will have to make. So 80,000 orders. Sorry, orders is anyway known. Orders is not known. No, number of units which we require, annual requirement is known, and EOQ is known. So let me divide that by this. So then we will get the orders, correct. So if I do this math, 80,000 divided by 7,200, I will get 11.11. Let it be like that. Okay, 11.11 orders. That is what we know. But one order right now costs how much? One order right now cost rupees 100. So into 100. So when you do that, you will simply remove this and this decimal here. You will be left with 1,111 rupees. That would be the cost. Okay, ordering cost. Ordering cost right now would be this, without using the cash discount. Now, if at all the company uses the cash discount, in that case, what would be the situation? So then 80,000 would still be required, but now the minimum order size would be 9,000. So that is the situation now. So we'll have to again do the math. 80,000 divided by 9,000, which is 8.888. Okay. So now this 8.888 per order would be how much? Again 100 rupees. So 8.89, I'm just rounding it off, into 100. So this will be 889 per order. So now without cash discount it is 1111, with cash discount it is 889. So the savings in this case would be 1111 minus 889, 1111 minus 889, 1111 minus 889. So in this case would be 222. So that would be the savings. And if you look at the answer, none of the answers are, or the other options are correct. In the guideline answers, you can check it out. The institute has mentioned that all of these options are incorrect. So the correct option would be 222 rupees. That is what it would result in. Okay, moving on. Theory question based on the Walter's model. Walter model can be applied only to those companies which earn high profits, make investment by resorting to high level of debts, make investments without borrowing or raising external equity, do not make any investments. See, Walter's model can be applied to only those companies which make investments without actually borrowing or raising external equity, because the model in fact assumes that the company's only source of capital is in fact equity share capital. When the model assumes that, and also it assumes that the company will utilize its retained earnings only to finance its future investments. When that is the case, we cannot have any other option as the answer except option C. Again, all these things are based on how, if you are thorough with the syllabus and if you have understood the concepts, you can finish the entire exam in, let's say, 1.5 hours. So that's how easy it is. Anyway, let's move on to the next one. The cash management model has been propounded by, again, this is a purely fact-based question. This has nothing to do with understanding. You should know the fact. That's all. The cash model has been propounded by Baumol. So his name is William J. Baumol. In 1952, he came out with this model. The model is in fact based on an assumption that a firm's cash balance fluctuates between minimum and maximum level. So the firm incurs a cost each time it converts its marketable securities into cash, and it earns a return on its cash balance. So that is what it is. So simple, straightforward question based on fact, nothing else. Next, the weighted average cost of capital computations, okay, again based on assumptions, assigns more weight to equity, assigns more weight to debentures, excludes retained earnings, assigns weights based on the market value or book value. Obviously this is the answer. If you have solved the problem, this shouldn't be that difficult at all, because this is how we solve the problem. No, what is weighted average cost of capital? It's a financial metric. What does it do? It measures the company's cost of capital in terms of average rate of return that it expects to pay on various sources of capital, predominantly debt and equity. So this is calculated, that is weighted average cost of capital is calculated by multiplying the cost of each capital source, that is debt or equity, by its relevant weight by the market value, then adding the products, you will get the answer. Very simple, straightforward problem, nothing much here. Option D is in fact the right answer. Let's move on to the next one. Okay, in this case we have a numerical problem. That's interesting. At least few of the questions are of practical in nature. The liability side of Shivani Limited's balance sheet shows equity capital of 25 lakhs and retained earnings 50 lakhs. Face value of its share is 100 each and the market value is rupees 300 each. Okay. If the investors expect a rate of return, equity basically, 18%, and if the cost of flotation of fresh equity is 5%, what is the cost of retained earnings? Oh, it looked like a practical question, but in fact it is a theoretical question. Okay. See now, cost of equity is nothing but cost of retained earnings, generally speaking. Okay. But one thing which you have to remember is cost of retained earnings is not adjusted for certain factors. These factors would be like tax, flotation cost, that is the cost which we incurred while issuing the shares. Okay, tax, why we won't consider here is because what is retained earnings? because retained earnings is something which we have after making the payment of tax. No, so therefore no need to adjust it for tax. And flotation cost will also not come into picture because it is a cost which a company incurs while issuing a new share. So if we are already using the retained earnings, then there is no question of this. So overall what we can say is retained earnings is considered to be the cost of equity without adjustments for flotation cost, without adjustment for tax. Okay, so in that scenario 18% would be 18%. Option B would be the right answer. Next, question number 52. Okay, the capital structure of NEEL Limited is as under: equity plus the reserves is given, 10% preference share is there, 12% term loan is there. What should be the approximate earnings before interest and taxes so that earnings per share is 0? Assume tax rate of 15%. Okay, in this case we'll have to work backwards because they have given the EPS. So we will start from EPS itself. Okay, let's see what do we have. So if EPS is 0, let me write down that EPS is nothing but earnings available to equity shareholders by number of shares. No, so I will start with that: earnings available to equity shareholders. EPS will be 0 only when earnings available to equity shareholders is also 0. So now when do we arrive at earnings available to equity shareholders? After making the payment to preference shareholders. So immediately before this we would have paid preference dividend. How much is the preference dividend? That's easy to calculate. 10% on 50 lakhs, which comes to 5 lakhs. So that is less preference dividend. So now from what do we deduct preference dividend? That is nothing but profit after tax. So profit after tax would be 5 lakhs. Exactly 5 lakhs, and we paid preference dividend of 5 lakhs, and there was nothing left to pay the payment to equity shareholders. Now profit after tax is 5 lakhs, but there is some tax component, so less tax at 35%. Okay, so now 100 minus 35% is 65. We know this 65 is 5 lakh rupees in our case. So in that case 100 would be how much? So that would be 5 lakh into 100 divided by 65, which would be 7,69,231. 7,69,231. So let me just cross verify. 769,231 into 35%, no, which will be 269,231. I'm just rounding off all the decimals. So this will be profit before tax. Okay, so now we have some interest payment as well. 12% on 150 lakhs, huge amount of interest payment. In fact, 150 into 12%, directly I will do this, 18 lakhs. So after removing this less interest, so then what is left is earnings before interest and taxes. So that would be 18 lakhs plus 7.69231, which is 25,69,231. So EBIT in our case is that 25,69,231. Option C is in fact the right answer. I hope it makes sense. Let me know if there is any doubt. Moving on. Question number 53. ABC Limited books of account show profit from operation EBIT. Okay, EBITDA at 500 lakhs. It paid 12% on debt of 1000 lakhs, depreciation 100 lakhs, and tax 35%. Profit after tax will be how much? Fine, let's see. In this case, we'll start with the EBITDA only because it's a straightforward thing. There's nothing much to do here. 500 lakhs. Then what else do they say? See, earnings before depreciation, interest and taxes. Less depreciation first. How much is depreciation in this case? 100 lakhs. So 400 lakhs will be EBIT. Okay. Then what do we have? Interest. Where is interest? 12% on 1000 lakhs. So less interest, which will be 120 lakhs. So this will be 280 lakhs, which will be earnings before taxes. Then tax is 35% less tax at 35%. Okay, 280 into 35%, 98. So that means 180, 182. So profit after tax would be 182 lakhs. Easy, straightforward, nothing much to do. Here there is no reverse working like in the previous problem. It is a straightforward question, nothing much. Let's move on to the next one. As you increase the number of stocks in a portfolio has five stocks, let's assume now it has 10 stocks, the systematic risk is likely to remain constant, increase at decreasing rate, decrease at a decreasing rate, decrease at an increasing rate. What is systematic risk? Systematic risk is that risk which is inherent to the market and it cannot be diversified away. It is not something which will go away just because you are diversifying. It is also known as undiversifiable risk or market risk. It is caused by factors maybe such as change in interest rate, inflation, economic growth, etc. So therefore, as you increase the number of stocks in a portfolio, the systematic risk is likely to remain the same or constant. So therefore, option A would be the right answer in this case. Let's move on. Question number 55. Okay, current ratio is 4:1, net working capital is 30,000, find the amount of liquid assets if stock is 8,000. Okay, sorry, again ratio analysis problem. First of all, let me write down the formula. Current ratio 4:1, they say. Fine, 4:1 or 4/1 also. So what is current ratio? Current assets by current liabilities. So in this case, current assets we do not know, current liabilities also we do not know. But if I cross multiply for y, for y would be x, that we know. Okay, because x is current assets, y is current liability. Now one more thing which they have written is net working capital is 30,000. But we know for a fact net working capital is nothing but current assets minus current liabilities. Okay, so current assets is x, current liabilities is y. Or you can simply write current assets is 4y minus y will be net working capital of how much? 30,000. So now solving for y, it will be 30,000 divided by 3, or in other words 10,000. If current liabilities is 10,000, then current assets would be 40,000. I hope this makes sense. Okay, so now what is the question? Find out the amount of liquid assets. Okay, liquid assets easy to find, anything which can be easily converted into cash. Current assets minus prepaid expenses minus stock, minus prepaid expenses minus stock. Prepaid expenses is not given, so that is out of equation. So therefore 40,000 minus stock, which is given in the problem, 8,000, 32,000. That's all. So option C is in fact the right answer. Next, question number 56. Now a sum of rupees 50,000 is invested at 12% per annum for 6 years. Okay, what will be the present value of its maturity value assuming a required return of 10%? First we have to find out what would be the present value. Okay, future value we need, no, before we find out the present value. Future value of this 50,000 if it is invested at 12% for 6 years. Okay, fine, let's try to find out that. Okay, future value is nothing but the amount invested, how much ever we have invested, into 1 plus rate of return to the power of n. Okay, so how much is the amount which we are investing? 50,000 into 1 plus r is 0.12 to the power of 6. That's all. So we can simply simplify this as 50,000 into 1.12 to the power of 6. So when you do that math, 1.12 memory into 3, 4, 5, 6. So 1.9 something you will get, 97. Of course, when you round it off, your answer will be slightly different. That's still okay. 1.97 now into 50,000. So this will be 98,691. So this is what we will get future value after how many years? After 6 years at the rate of 12%, basically compounding. Now what would be its present value? Okay, so present value can be easily identified. 98,691, if that is the future value, that divided by 1 plus r to the power of n. Again the same thing, but we are just dividing by what is that? The same thing what we used here to multiply. But here the rate of return changes because now the expectation is different. So required rate of return is only 10%. So 691 no. 691 divided by 1 plus 0.1 to the power of 6. So 1.1 no, 1.1 into 2, 3, 4, 5, 6. Okay, so this would be 98,691 divided by 1.771561. So 98,691 divided by 1.771561. So this will be 55,708. Okay, 55,708. This is the closest answer, so just take it. Of course there will be some amount of fluctuation because of the rounding off error, so that's okay. We found out the answer. In this case, the present value of this money which is compounded for the next 6 years would be somewhere around 55,700, 600, whatever. Some 30-40 rupees difference, doesn't matter. Let's move on. Question number 56 is done, no? Okay, last page, last 4 questions, that's all. The cost of capital of a firm is 12% and its expected earnings per share at the end of the year is 20. Okay, expected earnings is given. Its existing payout ratio is 25%. Okay, payout ratio. Dividend. The company is planning to increase its payout ratio to 50%. What will be the effect of this change on the market price of the equity shares of the company as per Gordon's model? If the reinvestment rate of the company is 15%. Okay, this requires some bit of calculation because there are 2 situations here. We'll have to identify under both the situations. Let us try to do that. So payout ratio, they say, is how much? 25% existing. So that means retention ratio or retained earnings would be 75%. So the price would be nothing but earnings into 1 minus retained ratio divided by cost of equity minus retention ratio, whatever it is, into the rate, reinvestment rate, this. So this is the formula to identify the price. So because we need to identify the difference, like what will happen if the retention ratio is that much, what will happen if the retention ratio is 50%, because right now it is, payout ratio is 25%, payout ratio is 50%. So let us try to plug the values, that's all. Earnings per share is 20 into 1 minus whatever is our retention ratio, which is 75%, 0.75, divided by cost of equity. In this case is how much? 12%. So 0.12 minus 0.75 into reinvestment rate, which will be 0.15. That's it. So do the math, you will get it. So 0.25 into 20, so this will be 5 obviously. So then 0.75 into 0.15, 0.12, so this will be 11.8875. Okay, something is wrong somewhere, no? Yeah. So 0.12 minus, what was that? 0.75 into 0.15. okay, 0.12 minus 0.0075. So when you do this math, 5 divided by 0.0075, you will be 666.67. okay, so this would be the price of the share if they retain 75%. Now the next option is payout ratio 50, that is retention ratio is also 50. So in that case, what would be the case? The formula remains the same. There is no change in the formula, only the values are different now. So now earnings will still be, okay, let me just write down the formula. So price will be earnings into 1 minus b, b. So 1 minus b divided by KE, that is cost of equity, minus retention ratio into investment rate. So earnings will be 120, no change there, minus 0.5. Retention ratio has changed now, only 50% is retained. KE remains same at 12%, minus B would be 0.5 into reinvestment 0.12. So now 120 into 0.5. So this will be, how much was it? 120. Oh, sorry, that's what I was wondering. Only 20. 20 into 0.5 would be 10 rupees divided by 0.5 into 0.2 would be 12 would be 60, no? Yeah. So 0.12 minus 0.06. So that would be 10 divided by 0.06. So this will be 600 then. Okay. So now the difference in this case, did I go wrong anywhere? Let me just check. Oh, I made a mistake. Retention ratio is not 12%. That is where I went wrong. Retention ratio is 0.15. See, one small mistake and the whole problem goes for a toss. And there is no marks for steps here. This is not a descriptive exam. So this will be 0.12 minus 0.075. So 0.12 minus 0.075, 10 divided by 0.045. Okay. So 10 divided by 0.045 will be 222.22. So this will be the new price. Old price was how much? 666 something, no? Yeah, 666. 666 minus 222. So the price is actually coming down in case you retain less and pay out more. By how much? By 444. So it will decrease by 444 rupees. Okay. Not a difficult question per se, but only thing is you'll have to remember the formula and you should be able to recall the formula at that exact time and also be able to solve it quickly. And this, it's okay. 1 or 2 questions like this will take some time, more than the average, but that's fine because most of the questions, at least half of them, will be theory based anyway. Okay. One more practical question is there. Mr. A is planning to buy a security and is in a dilemma regarding the price to be paid. Okay. For this, he is relying on the required rate of return on the security. Help him out to calculate the aforesaid rate if you are informed that security standard deviation is 6%. Correlation coefficient of the security with the market is 0.6. Standard deviation is 5%. You may assume that the return from risk-free security in the market is 8% and the return on market portfolio is 12%. Okay. Fine. Okay, let's see what we can do. So now in this case, help him out to calculate the aforesaid rate. He is planning to buy a security and is in dilemma regarding the price to be paid. For this, he is relying on the required rate of return on this security. Okay. Help him out to calculate the aforesaid rate, that is required rate of return. Fine. We'll have to consider CAPM here. Required rate of return, that is where we'll get it. No, what is the formula for required rate of return? Required rate of return would be RF plus beta into RM minus RF. No, risk free rate is given, no, somewhere that mentioned 8%. 8 plus beta is not given. RM is how much? Market portfolio 12 minus 8. The problem is we do not have beta to find out the required rate of return, but they have given the standard deviation, so that can be used. Okay, so security standard deviation is 6%. Okay, and the market standard deviation is 5%. So beta is nothing but, okay, standard deviation of security by standard deviation of market into correlation coefficient. If you remember this formula, then this will be easy. Standard deviation of the security is 6, market standard deviation is 5, coefficient correlation is 0.6. So let us do this. 6 6 are 36, that means 3.6 divided by 5, no? So 3.6 divided by 5 would be 0.72, that is beta. So now substitute 0.72 here. This will be 8 plus 0.72 into 4. It will be 2.88. So this will be 10.88. I hope that is there in the option. Yeah, 10.88% is the expected rate here. That's easy, not very difficult actually. Let's move on to the next question, the last practical question. Firm A is considering a project A. The project involves cash outlay of 50,000, working capital outlay, that is period right now, okay, working capital outlay of 20,000 year 2, and is expected to generate cash flow after tax of 12,000 per annum for the next 5 years, excluding working capital release back, and terminal value of 20%. Okay, there is some salvage value as well. What would be your advice to the company using net present value approach if its cost of capital is 10%, whether to accept the project, reject the project, or whatnot? Okay, let's try to do this again, a very simple problem. So now in this case, what is the present value of cash outflow? 0, year 0, how much are we supposed to pay? 50,000. That would be the outlay initially, and since we are paying right now, there is no question of present value, it will be 1 only, so that value will be still 50,000. But sometime in year 2 we are expected to spend 20,000, but 20,000 of year 2 will not be same in today's terms, so they are looking at a cost of capital of 10%, no? So let us do that. 1 divided by 1.1 to the power of 2, 1 divided by 1.1, first year, second year, so that means it will be 0.8264. this into 20,000, which will be 16,529. So 66,529 is the cash outlay. Cash outlay of what? Present value of cash outlay. Let it be there somewhere. Now we need inflows as well. One is outflow we found out. Now let us try to identify inflow. Inflow is 12,000 per annum for the next 5 years. Okay, 1 to 5 years they will get 12,000 rupees. Then 5th year they're also getting working capital release back and terminal value of 20%. Working capital release back means we'll get back. Okay, so at the end of 5th year, how much are we getting back? 20,000 rupees. And terminal value of 20%. 20% on the initial investment, which is 50,000. 5 2s are 10. So therefore 10,000 we will get back there too. 20% of terminal value of 20%, no? 25 2s are 10 only, right? Yeah, let me just read the question again. Fine. Yeah, so now for 1 to 5 years, what is the present value annuity factor? If you look at the table, you'll get. Otherwise, what I will do is I'll simply write down this 1 divided by 1.1. So 0.9090 or 0.9091. First year, second year 0.8264, third year 0.87513, fourth year 0.6830, fifth year 0.6209. Add all this. 0.9091 plus 0.8264 plus 0.7513 plus 0.6830 plus 0.6209. This will be 4.0907. Right. 5 years at the rate of 10%, no? Or 1 second, did I calculate correctly? 1 divided by 1.1 only, no? 1 2 3 4 5. Okay, into 4.0907. 12,000 into 4.0907, which will be 49,088. Then fifth year is 0.6209. Okay, into 0.6209. 20,000 into 0.6209 will be 12,418. Then 10,000 into 0.6209, this will be 6,209. When you total all this, 49,088 plus 12,418 plus 6,209, this will be 67,715. If 67,715 is the total inflow and the total outflow is 66, we can still accept the project. Okay, let me just confirm this with the guideline answers. What do they say? Question number 59. C. Reject the project, they say. Why would they reject it? Did we go wrong in the calculation anywhere? 12,000 and is expected to generate cash flow after tax of 12,000 per annum for the 5 years excluding working capital release back. That is also fine. 12,000 for the next 5 years, that means that calculation is fine. Now why would they reject the project? Okay, terminal value is 20%. 20% of 10,000. What else? Net present value will be positive. No, inflow is more than outflow. 0.9091 plus 0.8264 plus 7513 plus 0.6830. Last year they're still getting 5 years. No, 12,000 is anyway given for 5 years. It's not like it is only for 4 years also. Plus 0.6209. Okay, this is where I have gone wrong. I have not added properly here. 3.79. So that means this will be slightly different. My calculation was wrong. Into 12,000, which will be 45,488. So if that is the case, plus 12,418 plus 6209, in that case we are only getting 64,115. Now it makes sense. 4115. So therefore reject. Yeah, in this case it is correct. Okay, so that was the right answer there. Next, let's move on to the last one. Economic order quantity determines what exactly? Okay, let's see the options. The order size that minimizes the total inventory cost, the order size where the ordering cost is lowest, the order size where the carrying cost is minimum, the order size which will earn discounts on purchase. Okay, economic order quantity determines the ideal order quantity, which in fact minimizes the total inventory cost. So how do we calculate? It will calculated by considering the annual demand for a product, the ordering cost per order, and ordering cost per order, and the carrying cost per unit. So therefore option A is in fact the right answer. Nothing much to do there. So that's all about this question paper. That is June 2019. We solved this entire question paper. Of course we did it in parts so that it will be easy for you to have a look at it. That's all from our side. If at all you have any doubts or any requests considering the exam, that is the executive, please do let us know. If at all we can do it, we'll do it, because there's not much of time between now and the exam date. So I would say all the best. I hope you have studied well and you pass the exam in this attempt. So yeah, good luck and thank you.